4 fundamental facts about gold bullion. 1. You can't print more gold. The Federal Reserve continues to print fresh, crisp stacks of US dollars amounting to $85 billion every month, driving up the balance sheet to almost $3 trillion. If Ben Bernanke continues churning out dollars at this rate, by 2016, the balance sheet will more than double to $7 trillion. And research has found that the price of gold moves in near lockstep to each increase in the Fed's balance sheet. Even with the incredible 2-day drop in gold prices, U.S. global portfolio manager Ralph Aldis calculated that the correlation between the rise in gold and the U.S. balance sheet is 0.96. Perfect correlations of 1 are extremely rare in markets, but gold and the balance sheet have moved in sync with each other since 1999, before gold's bull run began. Number 2. Gold is viewed as a currency by central bankers. Investors should look at how central banks around the world are viewing their own reserves. The World Gold Council reported that in 2012, central banks purchased 535 tons, when only a few years ago, central banks were net sellers of gold. And it's important to keep in mind that these central banks love these corrections, as they can purchase gold at cheaper prices. Number 3. A lack of love from the love trade is affecting fundamentals. Too many people focus on the fear trade, which is when investors buy gold coins or a gold ETF out of a fear of the fallout which may result from governments raising debt levels and weakening currencies. The love trade, on the other hand, is the buying of gold out of an enduring love for gold. 2 emerging countries that make up almost half of gold demand, China and India, have had a long relationship with the precious metal that is intertwined with their culture, religion, and economy. With half of the world's population buying gold for their friends and families, it's important to put into context what is happening in their countries. It was announced this week that China's income growth slowed for the first quarter of 2013, with urban household disposable income rising only 6.7% on a year-over-year basis. This is down from 9.8% in the first quarter of 2012, and the slowest pace since 2001. This is very important to gold, as China's income growth has been shown to be highly correlated to the price of the precious metal over the past decade. China's weaker GDP also disappointed gold investors, but I believe this is only a temporary setback. It is only a matter of time how fast China will be able to stimulate the economy, since this is a key to global growth. In India, gold consumption has been hurt by both a weak rupee and government taxes on imports. Number 4. Corrections happen but have historically offered buying opportunities. While minor corrections in the gold price happen frequently, a move this severe has never occurred before over the previous 2,610 trading days. With gold's standard deviation drastically below the buy signal blue band, we consider the yellow metal to be in an extremely oversold position on a 12-month basis. The probability that gold will move higher over the next several months is high. However, there is still a very high probability that gold will fall down to the $1,200 range. Where do you think gold will be going over the next few months? And also let us know where you think gold will be going over the next few years. Let's all